Test 1, 2. Morning, everybody. This is the November 12.
Recording in progress.
Let's start that again now that's being recorded. Good morning, everybody. This is the November 12, 2025 meeting of the LACERA Public and Private Equities Committee. The chair notices the presence of a quorum. Madam Secretary will call the roll.
Thank you, Mr. Gatto. This meeting is being conducted as a virtual and in-person meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Gatto?
I am here.
Miss Me? Here. Miss Langton? Mr. Rue?
Yes.
Miss Martinez? Miss Ginsburg? Here. Miss Martin? Mr. Green? Mr. Jones?
Present.
Okay, staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, investment staff Chris Wagner and Didi Acevedo. We also have Jose Fernandez from Stepstone presenting. Trustees, please use your raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute your mic until you're ready to speak. And now we may proceed with the agenda. Mr. Gatto, I think the next item is the minutes, but since we don't have a quorum, we can go ahead and go to, oh, I'm sorry, we have public comment. So sorry.
Okay, so I did count a quorum, but it could be that my math is off.
Yes.
But do you wish to proceed with, can you read item 2, the procedure for teleconferencing meeting attendance without a quorum, or is that something we have to wait on?
So we don't have anybody participating under AB 2449, so we don't need to do that at this point.
Understood. Okay, so you're saying we do not have a quorum, so we cannot approve the minutes.
You are correct.
Okay, so that's item 4, public comment.
Thank you. So we do have public comment this morning. There's 4 individuals that will be addressing the public. I will call them one at a time. The first person speaking today is going to be Mohammed Abdeli. You can go ahead and approach the podium and you will have 3 minutes to address the board.
Good morning, everyone. My name is Mohammed Abdul. I work here as a porter for Sky Shifty at Phoenix Sky Harbor Airport for about 1 year. I'm proud member of Unite Her Local 11. I love my job. I help wash dishes and clean kitchens and make sure everything run smoothly so passengers quality get her meals on time. It wasn't just a job to me. It gave me stability and gave me the opportunity to support myself. When Sky Cafe took over the American Airlines contract, I applied right away for my job, for my old job online, but I never heard it back and never received an interview. So did my brother who went for a walk interview, but neither of us heard back after. I also applied at Armaki Sky Cafe subcontractor, but still not luck. Now I'm out of work and I'm so worried about how to pay my rent and support myself. Meanwhile, Sky Cafe hears lessons of people without period experience working at the airport to fill position like mine. I come to this country from Somalia, so I call the work hardy and boldly. I live a life for myself. I did everything right, but now I feel like it is slightly away. But Sky Cafe followed because Sky Cafe failed to help many of the people who already know how to do the work. I'm left with nothing, and it is my understanding that for transition has led to problems in surfing flights. Atlantic Street, Atlantic Street Capital, and its company Sky Cafe have caused this choice. I feel like Atlantic Street is treating me like a number, not a human being. Its situation is bad for the workers, and it is bad for investors. Atlantic Street is disrespecting essential workers, not performing the way it should be for investors. Please tell them to do the right thing, investing in workers like me instead of focusing as a side can only help me as the Atlantic Street level as done. Thank you.
Thank you. Next speaker is going to be Absheri Sakto. You will have 3 minutes to address the board.
Sorry.
3 minutes to address the board.
Okay. Good morning. My name is Abshir Sadal, and I work in utility for Sky Shift at Phoenix Sky Airport. 7 months. I am a member of unit here, local 11. When Sky Coffee took over the American Air contract, I apply right away to get my job back. I never hear anything. I also apply with Al Market Sky Coffee subcontractor, but still haven't been here. Now I am driving for Uber to try make end meets. Is help it, but it's not consented or subtain. Every week is uncertain, for I am not always here. I will be apply. I have seen apply to Air Manage to cover my bill. My way, Sky Cafe has hiring people who have never worked at airports, will background check and train employees like me, wondering how to pay my bill this month. And I like my brother come to this country from Somalia to work hard, build better life, and done everything I cannot be now. I feeling like at hard work and being taken away from me all because Sky Cafe feeling to her experience work like me. Please tell Atlantic Street to do right thing and bring back experience workers like me. Thank you.
Thank you. The next speaker is going to be Alex Rosada. Alex, you will have 3 minutes to address the board.
Good morning. My name is Alex Rosado, and members of the board, I am an organizer with Unite Here Local 11, representing SkyShip workers at the Phoenix Sky Harbor Airport. I want to start thanking this board and LACERA staff for engaging with us, for reaching out to Atlantic Street Capital about what's happening at Sky Cafe, one of its portfolio companies. Your willingness to listen and take this seriously means a lot to our members. Despite those efforts, the situation has only gotten more unstable. When Sky Cafe took over the American Airlines catering contract from Sky Chefs, last week, nearly 200 trained and security cleared workers were laid off, even though the work itself stayed exactly the same. Sky Cafe could have simply hired the existing workforce and ensured a smooth transition, but they didn't and declined to speak to workers representatives when we first reached out. Instead, the process has been chaotic and confusing. Based on the information collected by the union, about 19 former Sky Chefs employees were hired by both Sky Cafe and Aramark, most of which we believe ultimately opted for Aramark. Others were left out entirely, even after applying multiple times. Workers like Mohammed, who spent a year doing the exact job, have been left jobless and anxious about how to make ends meet. Meanwhile, around 13 Sky Chef drivers were allegedly offered jobs at Sky Cafe despite not being laid off at all. These challenges have led to alleged problems servicing flights. After the contracted transition last week, American Airlines still requested for Sky Chefs to service carts that Sky Cafe was supposed to cover, but allegedly couldn't due to operational challenges. Meanwhile, Sky Chefs had to hire many temps earlier this month to cover employees leaving for Sky Cafe. All of this could have been avoided if Sky Cafe had respected the existing workforce from the start. The labor dispute facing GATT, Sky Cafe at Phoenix Sky Harbor Airport is only one of many issues that should concern LACERA as a limited partner in Atlantic Street Funds 3rd, 4th, and 5th. According to LACERA's Q2 2025 Private Manager Scorecard, ASC performed poorly, scoring a 2 of 5 on ESG, with 5 the best, a 1 of 5 on performance, an S on organization and operations, an A on partnership, and 3 of 5 on fees and terms. Notably, Atlantic Street's ESG score was downgraded to 2 out of 5 from the prior quarter, indicating that even prior to any labor dispute at Phoenix Sky Harbor, investment staff identified concerns with the extent to which material ESG factors are identified, assessed, and incorporated into risk-return analysis and portfolio construction. We know LACERA has raised concerns with Atlantic Street, and we truly appreciate that. Unfortunately, this has not translated into a resolution on this dispute. We recommend LACERA reevaluate Atlantic Street's fitness as an investment manager, given its record of instability, layoffs, and poor performance. Thank you.
Thank you. And the last speaker is Jen Fong, and you will have 3 minutes to address the board.
Good morning. My name is Jen Fong, and I'm a researcher with Worker Power. As you have heard, it appears that LACERA's investment in Atlantic Street Capital Fund 4 was negatively impacted when the debt-laden acquisition Zips Car Wash went through bankruptcy this year. Under ASC's ownership, Zips acquired 95 additional locations, nearly doubled its annual revenue from $184 million to $345 million, and assumed $654 million in debt and $300 million in preferred equity before filing for Chapter 11 bankruptcy in February 2025. In bankruptcy filings, Zips stated that substantial funded debt obligations and maturities, macroeconomic headwinds, competitive pressures, and burdensome lease obligations constrained Zips' financial condition and ability to grow. Zips further reported that recognizing these headwinds, it negotiated savings with its vendor partners and optimized on-site labor and consumable spend. According to Aquashine Express Car Wash Chief Operating Officer Keith Lawrence, Zips' mission was grow as fast as possible. Lawrence stated that Zips cut labor costs by firing all the directors and all the ops team. According to Lawrence, site managers were often working alone or with 1, 2, or 3 employees max on the schedule. We've had a lot of their people come to us and ask for jobs. ASC funds equity stakes appear to have been wiped out when Zips emerged from bankruptcy on May 1st, 2025, under the new ownership of its lenders. ASC Fund 5 also faces significant issues. According to LACERA's AB 2833 report for the fiscal year ending June 30th, 2024, Fund 5 had called only $7,483,888 of committed capital, or 5% of LACERA's commitment, while peer funds from the same vintage year, 2022, had called 54% of committed capital. As of Q2 2025, Fund 5 had an IRR of negative 48.18% versus positive 18.92% for PitchBook's benchmark of 16 peer funds, underperforming by over 67 percentage points. Fund 5 also had dry powder of $337 million, or 81% of the $415 million raised. ASC is a case study of a private equity firm that has failed to deliver returns as should be expected and failed to adequately address pressing human capital risks. We encourage LACERA to ask the following questions. Why has ASC failed to deploy capital from ASC Fund 5? And what else explains the fund's negative 48.18% IRR? How much did ASC investors lose as a result of the ZIPS bankruptcy? And how much did ASC make in fees from the deal? How many workers were laid off as a result of the bankruptcy, and did they receive severance payments? What lessons should LACERA take from the ZIPS bankruptcy and Fund 5's precarious position, and how should the fund ensure other managers don't repeat ASC's mistakes? Thank you.
Thank you, and that concludes public comment.
Thank you, everybody. Thank you, Mohammed, Ashari, Alex, and Jen. We appreciate your input. Okay, so next on our agenda, unless a quorum has arrived, will be item number 5, which is the report on private equity education. We're going to turn it over to Didier and Jose.
I'll go first, Mr. Chairman, but good morning, Mr. Chair and members of the committee and board members in attendance. Today, we're going to cover a couple of educational items. It's been the theme over the year in these committee meetings. We have agendized several private equity or several educational items in the various asset categories. So today we're going to cover a couple of things. One's going to be the private equity and exit environment, and Jose from Stepstone, your consultant, will take you through that educational subject. And then the second part, second educational session, will be brought to you by Didier Acevedo, staff member, and he's going to cover some research that he's done on mechanisms that we can directly or potentially directly participate in initial public offerings. So if there are any questions for me, I will turn it over to Jose, and he will take you through the first item on the private equity exit environment.
Good morning, trustees. Good morning, everyone. As Chris mentioned, this continues the education series on the private equity side. My colleague, Natalie Walker, presented to this committee back in March on an introduction to private equity. So this builds on that by focusing on the exit environment. So if we go to the first page, or page number 3 of the presentation, this just sets out what the private equity life cycle looks like. It starts with deal sourcing. So a private equity firm goes out to find opportunities. There's various ways that they do that, a lot of different strategies around deal sourcing. And I'll just point out that deal sourcing can take anywhere from a few months to find an opportunity that maybe is presented by a broker, to many years of building a relationship with something like an entrepreneur that's starting a company, and the private equity firm develops a relationship with that entrepreneur until they're able to make an investment. From deal sourcing, go to the due diligence phase. That's when they really look into the company, the strategy, the market they're in, how they actually create value, what the prospects for that company are, and making sure there's no issues like potential environmental liabilities or other potential issues. Once they finish that process, they go to make an investment. The investment, once is consummated, the private equity firm responsibility then is to create value through operational improvements to that company. So they help that company grow, both its top line and bottom line profitability. That process typically takes from investment to exit, which is the next and final point of the life cycle. Between 4 and 7 years is the typical holding period for a private equity firm from investment to exit. We'll talk about how those periods have been elongated recently, and that's why I say just typical. But you can see that it can go from a as short as 4 to 7 years to as long as 10, 12 years is that relationship building period. Takes a few years to result in an investment. Going to the next page. What are the private equity exits? There's different paths to exit, not just one. So starting with a sale to strategic buyer. This is when you have a company that's getting acquired by another established company, which may be a public company or a private company that is usually either in the same industry or a complementary industry. And the company buying the private equity portfolio company is looking to either expand in that industry or look into adjacent areas of the industry, and that's why they make an acquisition. So that is a very common exit path. It's just selling to a well-established strategic buyer. Another avenue is a sale to a financial sponsor. That's essentially the private equity firm selling its portfolio company to another private equity firm. That is also a pretty common exit path. Then you have initial public offerings. These are when a private company offers shares to the public markets by listing in an exchange, like the New York Stock Exchange or the NASDAQ, for example, and they sell shares to the public market investors. So the company will no longer be a private company, but is now listed on an exchange, and anybody in the public is able to buy those shares. Whereas as the company is private, the availability to buy shares in that company is not a viable path for most investors. And then we have what's been a new innovation over the past 5 to 7 years in the market, which is what we call general partner-led secondary sales, or GP-led secondaries, as it's commonly referred to. This is when a private equity firm transfers one of its portfolio companies to a newly formed fund that's usually managed by the same general partner. So if they are selling it from their fund to a newly formed fund that they also manage. And that allows for limited partners to either take liquidity, sell their interest in that particular company, or to remain investors alongside new secondary capital that comes in from other investors. And we'll talk more about this during the presentation, but as I mentioned, this is relatively new, and there's a lot more capital coming into these type of transactions over the last few years. Now, how do these exits look like in terms of, by type? What does the market look like? What is the share between each of these types of exits? So we've laid those out, each one of those here, over the last 5 years, what the share of each of these exits is. You can see that the GP-led secondaries, as I mentioned, in 2020 was basically non-existent. As of 2024, it was 18% of the exits. As of the first half of this year, it's represented 35% of the exits. So obviously, a very quick ramp up, but a very meaningful part of the market today is this GP-led secondary market. And what we see is that there are funds that are being raised just to invest in these GP-led secondaries, whereas it used to be there's secondary funds that would do this type of investments. Now those secondary funds and others are raising dedicated capital, and that's why you see the increase in the share. But you can see that throughout this 5-year period, sale to corporates, which is the green part of the chart here, has always been a pretty significant part of the exit environment, but that has been dramatically reduced in certainly the first half of 2025, but it was significantly less than usual, which has always been more than 50%, close to 60% of the exits by dollar volume in the past several years. It was down to 40% in 24 and 27% in 2025, with a lot of that volume taken up by those GP-led secondaries. You also see the sponsor to sponsor, or a general partner fund to another general partner fund sale has also increased quite a bit in the last couple of years. And then the IPO market, we mentioned the initial sale of shares to the public through a listing in one of the stock exchanges. It was a meaningful part of the market in 2020, a very meaningful part in 2021 at 26%, but that went way down in 2022 to 5%, and recovered a little bit in 23 and 24. And you can see the first half of 2025, basically IPOs at 2%, not a very meaningful part of the market. So that ebbs and flows. But as you can see, historically, it's been an important part of the market, just not as robust as the sale to corporates or the sponsor to sponsor transactions are.
Mr. Chair, I have a question, if you don't mind. Are you on? Okay, thank you. So in that dynamism that we see moving from 2020 to 2025, is the diminishment of corporate exits a function of reduced interest, or is it a function of other private equity firms being more aggressive about staying in the game longer relative to their competition with corporates? What's the dynamic there?
Yeah, we'll talk about the on the next page about the key impacts. Maybe I'll go there. Key impacts that exit or to exit activity, right? What are the drivers of that change that activity? I think that why corporates decline in this activity, first of all, the competition from these GP-led secondaries, right? So there's a lot of capital coming into that market, which means they may be willing to pay more than a traditional corporate might be willing to pay. So there's that dynamic going on, but also there's just general instability around regulatory changes, the tariffs that were instituted earlier this year and how that has changed from month to month. Has an impact on how corporates look at the world, and they might take a pause in strategic acquisitions while they figure out what the impact on their business is of things like tariffs, changing geopolitical environment, and the interest rate environment, right? We do expect as interest rates tick down a little bit earlier this year, and expectations is they may continue to tick down. If there is continued reduction of interest rates, we expect corporates then to increase their activity.
Right. So the other part of the question then is, did the high leverage point in that kind of stack of potential exits there, if I hear you correctly, you think is across these, the most sensitive one is the interest rate one, because that would seem to then provoke more corporate people off the sidelines into the exit? Because the weird question or the weird dynamic I'm trying to understand and get your thoughts on, Jose, is if secondaries is really kind of a GP-led game, if you go back to the stack real quick, go back one slide. So the GP-led one's 35%, the sponsor to sponsor 36%. Then it seems like it's kind of private equity people just switching money amongst themselves, and the real kind of exit market, if you will, is the 2% making it to the IPO and 27% to the corporate. What does that say?
Well, look, I mean, one of the reasons we're talking about this, right, is you also take these percentages. We're not talking about this doesn't superimpose, what how many exits there have been, right?
Right.
But there have been a lot of less exits over the last 3 years than historically.
Mm-hmm.
And again, I think we'll see some data on that in the next few charts. But what we believe exits are happening, right? But they are happening with some of the best assets. So sort of let's call it the A-type assets that are held by these GPs. So because the exit volume is down, so it means transaction activity is down overall. And I wouldn't say interest rates is necessarily the most important. I think they all have their weight. I think regulatory impacts of things like tariffs, and also, potential deregulation might help break this logjam of lack of exits. So I think it's hard to just look at the fact that, you know, IPOs are at 2% and the corporates are way down, just because the exit environment is more limited than it was before. So what we would expect is this GP-led secondary market is definitely here to stay. As I mentioned, you know, dedicated capital being raised for it. I'm not sure that the share of the exit environment is going to stay at 35%, because as companies, strategics come off the sidelines because they have more visibility into the future, they have more visibility into interest rates, you know, their share may go closer to the 50% historical rate. And then, you know, it does mean the IPO market being you know, less significant may continue, and it is one of the, sometimes there's a misconception that if the IPO market is closed, that means there are no exits. Well, you can see here that's not necessarily true, because it's always been a minority part of the whole exit environment.
So in net, should we as a fiduciary board, as our staff comes to us with the reports on private equity, and we look at the last 2 or 3 years of maybe non-historical performance that's through there, should we expect more non-historical performance in the near term?
No, I think the message, and you will go through it in the next few slides, is that the market is cyclical, and the private equity market's been down relative to public markets the last 2 or 3 years. We do expect that at least the private market will recover. We don't know what the public market will do, but that the exit environment will improve. There will be more exits. The valuation environment will improve, and the performance from private equity therefore should improve.
All right, thank you, Jose. I didn't mean to put you in the hot spot, but I am sincerely interested. Thank you.
Thanks.
I think I see another question. We're going to keep going with some more questions right now. Mr. Rue.
Thank you, Mr. Chair. And I was going to hold off till the end, Jose, but then since Trustee Jones brought it up, and I thought it will segue right into it. For the GP-led secondary exits, can you give some of the pros and cons, or some of the, I mean, as far as LACERA is concerned, how it benefits us, and also what are some things we should be worried about or look for?
Yeah, that could be a whole topic of education on its own. So I'll try and keep it as brief as possible. But as with everything, there are positives and negatives. I mean, the positive is obviously it's become an important part of the exit market. So it does provide liquidity for your existing investments, as these pools of capital are willing to buy assets from other private equity funds. That's a positive. These companies are able to trade, and what typically happens is, for existing investors in those companies, they have the option to either take the liquidity, so take cash, or to roll over, meaning stay in the investment and now start a new holding period, which may be another 4 to 7 years, but enjoy the capital appreciation that may come from that. The assets that are trading to these GP-led secondaries are the best assets at this point in time, right? That may change. And that's why the GPs are doing this, because they feel like, and how we know they're the best assets, they're usually assets that have produced at least a 2 times rate of return. Not unusual to see 3, 4, 5 times rate of return. So good outcomes for the existing investors. That's why some of them choose to just take the liquidity. But the GP feels like there's still a lot of room to continue to create value and maybe generate another 2, 3, 4 times of investment returns. So that's positive. Now, as a negative, right, there's potential conflicts of interest, because it's the GP selling an existing asset to a newly created vehicle where they're going to continue to receive fees. Typically, they crystallize fees on the initial investment, although as the market has evolved, the terms have gotten better for limited partners, because now they're usually required to take all those crystallized fees, mainly carried interest performance fees, and roll them over into the new investment, so they don't get to cash that out, but actually show their conviction and say, okay, we believe so much in this asset that we're going to take everything that we had invested in, plus the fees we have generated, and roll them over alongside the existing and new investors. So the market was more difficult at the beginning. There were a lot of conflicts that maybe went unmitigated. I think as the market has evolved, they're getting mitigated and it's a better environment. So overall, we see that as a positive, but always mindful of the potential conflicts and making sure those are mitigated and well thought about.
Thanks for that. I mean, you brought up a lot of great points, and I don't want to belabor it, but just real quickly, an average private equity earlier in the presentation, you said is about 5-year hold, right?
4 to 7 years. Yes.
4 to 7 years. Can the could the investment on its own lengthen the investment to a longer term instead of doing a GP-led secondary?
Yeah. So that's a good point. What usually happens is the assets that are being sold in a GP-led secondary are assets that have been held 4 to 7 years already. So naturally, they would be sold and liquidity provided to the LPs. But once the GP-led secondary comes in, yes, now the expectation is that is going to be another potentially 4 to 7 year hold on that investment. And that's why, again, some of the existing investors decide this has been a good investment. I made 2-3 times my invested capital, so I might as well just take the cash and reinvest it somewhere else rather than keep it in this asset. But that's why we see as a best practice is, as a limited partner, you get the option whether you take the cash or you roll over and start the clock again on these 4 to 7 year investments. So yeah, that would make it, if you roll over, potentially an 8 to 14 year investment instead of 4 to 7.
Do we know, LACERA, how much we do GP-led secondary reinvest? We probably don't have that right now, right?
We don't have the actual number. We have done a few, but many times we do take liquidity when there is a transaction. But we'd have to get you that number, Mr. Rowe.
Right. So, Mr. Chair, I mean, like Trustee Jones, I'm very interested in this too. Maybe we could have a continuation later on in a future meeting. But because the big thing, my end question is, with all the pros and cons, should we stay away from the GP-led secondary, right? Because I mean, it might look attractive, but then it's basically an exit for the principals of the fund to basically cash out, right? I mean, we could cash out too. If we just cash out, that's fine. But if there was that much value in it, wouldn't they just continue the fund? But you don't have to necessarily answer that now, but I think this is a longer discussion. But yeah.
But that is, yes, I mean, that is one of the reasons is that they, limited partners, once the asset hits 4 to 7 years, right, they expect liquidity. So this is one of the solutions is the GP is facing this, in their mind, this dilemma of, we really like this asset. We think if we held it for another 4 or 7 years, it would compound our returns. But you're going to have some limited partners that say, yeah, but our deal was you're going to hold it for 4 to 7 years and give us back the money. So this is kind of a middle ground where those who choose to stay can stay, those who choose to leave can leave. And like I mentioned, the market has evolved to where the general partner does have to now be completely aligned with that decision, which is, yeah, you're selling it. You're crystallizing your fees, but we're going to make you take all those fees and reinvest them in these assets. So if they thought that's not a good idea, they probably wouldn't be selling in a GP-led secondary.
Fantastic, thank you. Are there any other questions? I want to be mindful of time. We still have more of the presentation and then a couple of other items. Okay, presenters, please proceed.
Great. I'll speed up a little bit. We talked a little bit about the impact, the key factors affecting exit activity. So just quickly on the historical exit activity, this just highlights what I talked about in terms of the last 3 years being a lot less distributions or realizations of portfolio companies than the historical average, which what we show here is, as a percentage of the net asset value of a portfolio, how much is distributed on an annual basis. And this goes back to each year to the year 2000. And you can see the historical average is 21% of your net asset value. So LACERA sits around $13-14 billion of private equity net asset value. The historical average would have been that you get 20% of that every year as distributions. But you can see that it was half of that basically over the last 3 years. And that has held during 2025. What you can see is the first half of 2024, we had 5% of net asset value distributed. That ended up being 12% over the year. So obviously distribution activity accelerated the second half of the year. First half of this year, we have the same as last year. 5% of net asset value has been distributed. This is not LACERA, this is across the market. And we do expect that second half of the year, like last year, there's an acceleration of exit activity for a variety of reasons. So we would expect that it's going to be in the 10-12% range. So again, still half of the historical exit average. So if you go to the next page, talking about how valuations impact exits. This chart shows you the multiple of that these companies were sold at. So this is the multiple of profits of earnings that were paid to buy assets or when assets were sold. And these the differentiation is the small middle market of companies and then the large market companies. You can see large market companies always command a higher multiple than the small market. There's a variety of reasons for that. And that valuation environment has been going up since, if you look back here to 2015, we've gone from 10 times in the large market, 7 times or 8 times in the small market to today, 15.5 times in the large market, almost 10 times in the small market. So, that this just shows you that valuations have gone up over time. That's true in the private markets. That's true, obviously, in the public markets that have done really well during this period of time. But there's, in order for sale, for the liquidity to increase, we need buyers and sellers to come to an agreement of what the clearing market multiple is. I think this reflects the fact that buyers probably think that these multiples are a little high, and that, or that's why they're not buying. So we need to clear that bid-ask, bid-sell spread, right? How we get there, either the sellers come down or the buyers come up. But that shows you the environment here.
So Jose, and that then begs the question of, in the supply-demand equation, if we have so much demand going into that's being placed in private equity companies, kind of by definition driving up the valuations because people have to do it, but then there's no buyers on the other end. I'm trying to guesstimate, like, who's the interest rates come down, maybe corporate money comes off the so and so, but is that enough to absorb all the backlog of PE that's going on, increasing valuations, and then need some kind of peak valuation on behalf of buyers in order to generate the return?
Yeah, I mean, corporate capital coming back, IPO window being open, right? That's going to increase the demand for these assets. I'll also point out, this is now a relatively large market, right? The private equity market is over $11 trillion of net asset value. Now, there's 31% of that, which is a big number, right? Let's be conservative and say something like $3 trillion is dry powder, meaning capital that's available to be invested. So the capital's there between corporates, the dry powder, IPO window opening. There's capital to clear this backlog of companies. So that's why we expect that distributions will pick up. Now, this question about, well, are companies too richly valued, right? Here's some analysis we did looking back from 2015 to today. How do valuations look like relative to the actual sale price of a portfolio company. So if you look back 5 quarters before the company was sold, and this is a asset by asset analysis or company by company analysis, 5 quarters before, the long-term average, if you look 10 years back, was a 20% uplift in value. Now that has actually come down to 16% if you look at just the most recent 5 years. So that means either, you know, the private equity funds are getting better at valuing the company, so there's not that much undervaluing of the performance, or if you look at this more positively, you can say if we go back to the historical average, that means that the actual value at which companies will be realized is higher even than the price that is marked at today. What happens is these companies, right, 5 quarters out, the seller doesn't know exactly what it's going to sell for. You can see that valuation gap narrows 3 quarters out, and then 1 quarter out, they're basically just fairly valued. Now, which is a good sign because it means that even recently, right, there's a 1%, the company is sold actually at 1% less than they were valued at 1 quarter before, but that's essentially, you know, what they were valued at is what they sold for. That means that these GPs are fairly valuing the companies. As they get more clarity that the company is going to sell and what price it's going to sell, they market correctly. But that there's uplift in your existing net asset values, you know, there's still uplift in the valuation, and they're not, you know, likely not valued on the upside, richly valued, right? So there's potential for additional gains. And I think these the hold periods, right? This chart just shows you the increasing hold periods, right? So the companies are being held longer than historically they have been, and a large number of companies that are being held for more than 4 years. All those assets are for sale, right? And they need to be sold. And that's why, you know, these share of assets at only 40% held less than 4 years, when typically that's closer to 50%. This again shows there should be more exit activity coming up.
Jose, another quick question for you. So then, given what we know about secondaries, the increase of dedicated funds going to that, and maybe this is more John Grable question, but is part of your counsel to us is to, rather than kind of extend in pretend/hope, should we kind of take more money when it's offered in the secondary market? You know, if our original vision was 4 to 7, should we be taking the offers more often? Or do you feel like the best assets that are going into secondaries are truly worth the additional 4 or 7?
Good morning, Mr. Chair, trustees. I think my name was summoned, so I will
Thank you.
provide an answer. I think that I think that there's one other variable that hasn't been mentioned, and maybe two. The first is it's rare that there's a market that it's a good time to be both a buyer and a seller. So I think that we just need to be mindful that if we're investing for the long term, we need to be mindful that we're making investments that may be optimal for new investments or to realize returns from prior ones. So I think that's part of the answer, and that just goes to the new dynamic with secondaries playing a larger role, just bearing in mind that we're a secondary player also in terms of looking at our portfolio. The other thing to contemplate is, and I'll say this not as loudly, retail. I think that the entrance of retail and mass into private equity may change the whole dynamic, and that may be good for us in terms of exit. That may be all this new capital coming in. What's the best way to start new funds, but for those funds to be secondary funds? So that may be exit opportunities for us. So what I would recommend to the board to more fully answer all the questions raised today, once again, being mindful of time, as the committee chair mentioned, is that next year we have a strategic asset allocation exercise, and that as part of that, we should look at our private equity allocation, the sizing of it, to maybe it's time to either lean in more, recognizing that it's good to not be a momentum investor and kind of lean into the wind, or maybe it's time to step back. And I think that we can use different assumptions in terms of prospective private equity returns to do that. And I would encourage us to do that.
Thank you, John. Go ahead.
Thank you. What I'm going to do is just because we have our regular meeting starting in 8 minutes, I'm going to ask the presenters if they could quickly wrap up, and then I'll ask if there's any more questions from the board. But just ask everybody to be mindful of time, please.
Yeah, and I'm sorry because we have another presentation, so I'll finish with this this slide, which is to sum it up, right? Some of the questions. I think this addresses some of the questions as well. I mentioned before, it's been cyclical in terms of performance for private equity, but if you look at the last 25 years, the fact is only 6-7 of those years private equity has underperformed. So the vast majority of years, private equity outperforms the public market. But there are periods, and we are in one over the last couple of years, as you well know, where private equity has underperformed the public markets. But again, as long-term investors, you would expect to, continue to be exposed there and enjoy the hopefully what the next part of the cycle brings, which is that outperformance again. So I'll turn it over to Didier.
Thank you. And what I'm going to say is just before Didier starts, because I mean, obviously we have 6 minutes left. I don't think it's possible to give a presentation in 6 minutes. We will probably, I will probably call another meeting, because clearly there's a lot of interest in this, and it's very valuable education. And I think the committee members really have a lot of interest in this. And so maybe we can do another meeting, before the year's end, maybe after the next meeting or something like that, and where we can go into some of this stuff.
Mr. Chair, we did start late, and as until Chairman Green gets here as the presiding officer of the next session, if you wanted to bleed in by 10 minutes, I think that would not be appropriate, just to allow Didier the opportunity to finish in that sense. So just another data point for you there.
Well, that's helpful. It's very hard to, as you know, chair a meeting from Zoom. I can't really see the room that well,
exactly,
even with glasses on. So, all right, yeah, if our presiding officer is not there for the next meeting, then Didier, please go ahead and make your presentation. Still, please keep it short, and if we need more information, we'll be sure that we make sure that everybody gets it.
Sure thing. Just wait for the presentation to, or is it right after? Okay, so we'll try the 2-minute drill version. Good morning, trustees. LACERA recently experienced pretty impressive gains by participating in an IPO, which led us to do research on IPO participation rights. And so Jose covered what an IPO means when a company goes from being private to public by listing on an exchange. Our research was conducted both as desktop methodology, and we spoke to our private equity managers, our consultants, and even spoke with lawyers to see which ways we could participate in IPOs. There are 3 main mechanisms. The one that's most pertinent to private equity is that we own private companies that eventually become public. Sometimes we negotiate rights to participate, or excuse me, we can negotiate rights to participate in public offerings. When we don't have those rights, we could always ask the private equity sponsor or the company to help us with a directed share program or concurrent offering, but there are typically more restrictions involved in those offerings. And lastly, there are convertible debt instruments that have the ability to convert to equity and also purchase more shares of equity at a fixed price. As we started doing research, we recognized that there was something called the IPO pop, which is on the first day of trading, IPOs tend to trade up. So over the last 44 years, as seen here, the number of IPOs are in the red bars. Every year has been positive on average for all the IPOs during that period of time. And the average of the first day trading has been 19%, with a low of 4% and a high of 71%. So that led us to think about, is there a systematic approach to capture the IPO pop? Are stocks mispriced at the day of their initial offering. And the longer term data is mixed. So there's a lot of information on this slide. Let's just focus on the right-hand side for the right-hand side of the slide for the interest of time. So the green bars represent the returns on the first day. All of them are positive across all time periods, 1980 to 1989, for example, on the left-hand side, or 1980 through 2023 on the right-hand side. The next bar, which is the light blue bar, represents the average one-year return. You can see that the results there are a little mixed. There are a couple of periods where one-year results were negative. The dark blue bar represents three-year returns. And for the most part, with the exception of the dot-com bubble, three-year returns were positive. However, that doesn't take into account that over a three-year period, the market may move as well. So on a market-adjusted basis, what it seems to indicate is that IPOs underperformed the broader market in almost all periods. So as we were thinking about that, our summary of the findings were, one, long-term outcomes are mixed. And really, while there is a first day return that seems very positive, it's hard to capture because most investors cannot liquidate within a year. This also goes for insiders at companies. They don't capture this upside as well. But secondly, we can still participate in some of these IPOs if we think they're interesting. We have mechanisms to work with our managers, but we should do it selectively. And third, there's an evaluation framework that takes on multiple dimensions so that we don't expose the fund to too much risk. So in closing, there are several mechanisms to participate in IPOs. We did the research to see if there was a feasible systematic strategy. The outcomes were mixed. And LACERA will continue to monitor the IPO market and come back with the board with any assessments and updates.
Fantastic, thank you. I have a quick question, and I think I'm summarizing what your summary was in very excellent presentation. It would seem that IPO returns have reduced or diminished lately. They're not the same that they were during the heady days of, yeah, that was that last slide there. I mean, they've diminished a little bit from the COVID mania and certainly from other eras. It also appears that, because of lockup restrictions and things like that, the first day pop is often hard to capture or hard to trade because, because of restrictions. And then finally, I'm coupling this with what Jose said, right? I'm trying to synthesize what you guys taught us today. It appears that, because some of these exits are lasting longer and longer, the IPOs are not necessarily occurring at an earlier period. And therefore, it would seem that some of the returns are already baked in by the time a company goes public. Is that a fair summary of things? And what does that mean in terms of, should we be even looking at IPOs at all at this, given these market conditions?
So excellent observations. Agree with you. And it further validates sort of the outcome, which is there's no systematic approach that we should participate in every single IPO. That said, IPOs over time join major indices, and we will get exposure to some of these companies via our global equity portfolio.
Makes sense. All right. Do we have any other questions from the members of the board who are present? Okay, seeing none. I'm told we don't have a quorum, so we're not going to go back and approve minutes. So I guess that brings us to item 6, which is items for staff review.
I don't have anything.
Nothing for that. What about item 7, items for future agendas?
Nothing.
Mr. Rue?
Thank you, Mr. Chair. I don't want to belabor the fact, but as you stated, I think there's a lot of interest in these slides. And on that, for a future educational presentation, if I could ask, the current climate in the stock market is just incredibly just doing well, which is kind of scary. And then you have like a lot of the industry leaders selling off a lot of their portfolios. But in any case, can we, for a future item, and I think the chair said that he would like more in-depth on the current items here too. But if we could have some sort of real life examples, and I know the investment board brings to our board like successes and failures of, well, I don't want to say failures, but very well performing funds and underperforming funds, and reports to us on a case by case basis. But if we could use something like that to give the board, at least our committee, on how the staff makes future decisions or makes investment decisions or reinvestment decisions. And maybe we could use the past fund successes, well-to-do funds and funds that have poorly performed as the backdrop, as real life examples. It's something that we talked about, Mr. Chair, offline. I don't know if I'm summarizing it correctly, but yeah, I just wanted to add something more to the a future educational item.
Sounds good. Ms. Mee?
Thank you, Chair. So I hope about my questions so I don't make the meeting longer, but I do want to say real quick is that this whole year a committee meeting, I believe mostly excellent education sessions. But I'm thinking like most of trustee, probably they're not on the committee, they don't show up or they cannot make it. So I think suggestion have made in the past that we should clip those video, the training section, and put it somewhere, make it available to all the trustee. If they may, ask our acting CEO, the director of communication division to do that and compile and put it together in all the training, including other side of the training too. So that would be wonderful, and then make it accessible to all trustee in case they miss a lot of them. Yeah. Thank you. That's our suggestion.
Mr. Chair, you're on mute.
No, I'm sorry. Yeah, I'm sorry. There's a lag here. If I'm hearing the requests accurately, it sounds like this was a very excellent presentation. I agree with that, and that you're saying it might be helpful for it to be in a training presentation. And then I want to also address what Trustee Rue said, and that is, I do think it would be helpful to get a more advanced presentation on the leaders and laggards and some of the risks that we have, including frankly the risks that the public commenters spoke on today. And no, this is not asking for a presentation on Atlanta Capital, with all their hassles and headaches and stress that they're causing us. I do think it would be helpful to get a general presentation on what are some of the factors in the public and private equity market that is affecting our investments. And what we can do is we can do it after a meeting. I don't want to try to rush it before a meeting. And if people want to attend, if we have a quorum, great. But I think that would be very, very helpful for all the members of this committee from what I'm hearing.
Yeah, and Mr. Chair, if you could add to that, how our investment team makes the decisions on exactly what was presented today, right? The GP-led secondaries, right? How our investment team, what factors they use to reinvest or just liquidate or make decisions on future funds, right? If it's the same leadership makeup, what factors they use. So just want to learn more about how things are done during these times.
Yeah, no, that's a fair request. Happy to do it. And like I said, we can calendar something for after a meeting, and those who want to stay can stay. Those who want to, other members of the board who wish to sit in, respecting limitations and everything, would be just fine. And I think that's a very, very good idea from everything that I've heard from so many sources today. Anything else for items for future agendas? Seeing and hearing none, good of the order. Any items for the good of the order? Seeing and hearing none. So what I'm going to do then is we're going to shortly adjourn the meeting of the Public and Private Equities Committee. I believe the tradition or the practice, is to take a short break before the meeting starts. So Trustee Jones, am I assuming that we should maybe come back at 9:10 to start the regular meeting? It's 3 minutes.
What, let's just give it to 9:15. Jason just got here, so in the transition. So 9:15, we'll start with the regular BOI public meeting.
Sounds good. So the Public and Private Equities Committee is adjourned. We'll see everybody at 9:15.